Hi, this is Nick Katko from BMA, and welcome to today's webinar on box score decision making. For those of you who attended the original webinar a few hours ago, there were some technical difficulties with showing my screen. So what I'm doing is re-recording the webinar, making sure that you can see my screen as I'm double checking here. And this webinar will be a little bit shorter. The fact we're not going to be doing the polling questions, but all the content will be the same. So let's get started with the webinar. And I'm going to continue to double check to see if my screen is showing. So today's learning objectives are threefold. First is I would like you to be able to understand the three components of the box score, be able to explain why a box score improves decision-making in a lean organization, and be able to describe the different types of analyses where box scores can be used in lean organizations. Today's agenda is fairly simple. I'm first going to describe the components of a box score in detail, explain why a box score is important in a lean organization in the context of a lean business strategy. I'm going to show you some examples of how you use the box score for lean decision making, and then we'll have a wrap up. And because this is a re-recording, we will not have any questions. The box score is the foundational tool for a lean management accounting system. It's comprised of three components. Performance measurements that focus on the process that really are leading indicators to show improvement. Looking at the profitability of a value stream. And the third component is being able to measure capacity. So we want lean performance measurements in place. They are leading indicators of the progress that lean principles, practices, and tools are making, because you can see immediate weekly results if you're making improvements. The capacity is measuring or quantifying what percentage of time a value stream spends on productive value-added activities, what percentage of time they spend on non-productive activities, which really are wasteful activities that we try to eliminate over time. The available time percentage doesn't mean that people are sitting around or machines are idle, but it's just a reflection of the level of improvement that is being made and the capacity being created. Because I will explain this a little bit more in detail later, lean creates a lot of capacity through the elimination of waste when you employ improvement activities, and we want to be able to measure it. The value stream income statement is just a breakdown of the total company income statement. What are the actual revenue? What's the actual revenue? What are the actual costs of a particular value stream? What we're trying to do with the box score is understand these relationships between operating performance, capacity performance, and financial performance. So let's look at the three components of the box score in more detail. The first are lean performance measurements. This combination of measurements really is necessary in a lean organization because it's going to give you an idea of the progress that lean makes. And this combination of measurements really works well in a lean organization. We're not talking about KPIs. We're not talking about traditional measures. What's really important is for a lean organization to rationalize the measures that they use, make sure they're lean focused measures and not traditional measures that focus on mass production manufacturing practices. So the idea of improving productivity, the idea is simultaneously trying to improve productivity, delivery, inventory, quality, cost, lead time, and as a result, if you are delivering value, achieving more sales growth. And it's just, I can't stress enough how important it is, not just for operations to have these measures, but it's also very, very important for finance and accounting people to understand these measures, because in the long run, understanding the performance measurements are going to give you the root causes of operating performance that is maybe hindering improving financial performance. So the lean performance measures are really where you do the root cause analysis of poor financial performance. And this is a shift between just looking at the financial numbers and then trying to understand the root cause. It's about understanding the relationships. So I'd like to give you a few examples of typical value stream measures. First is productivity. And a typical measure that's simple and easy to calculate is sales over hours worked. Productivity is measuring value-added output over effort or input. So sales is the best indicator, and this could be in monetary units, dollars or euros. It could be it could just be in units of product. And that's your output. And hours worked, and this could be people hours and or machine hours, depending on the value stream. That gives you an idea of the effort, the input. And over time, if you are making improvements, putting pull systems in place, you should be achieving more output with the existing resources. That's why this is a good, simple, easy measure to use. Delivery, everybody measures on-time delivery. The question is, are you measuring it to customer request date or to promise date? Many companies I've worked in over the years, companies look at it both ways. Obviously, the promise date, you get a very good measure, performance measure. Customer request date might be a little bit less than desirable. And it's really, really important to internally measure to customer request date. Now, I'm not suggesting that you stop using the promise date, but internally you want to measure to customer request date because it's going to reveal the real problems and issues preventing you from meeting the customer request date. Ultimately, the goal is 100% on time to customer request date. That is value to the customer. Sorry about that. Material flow, or just flow, days of inventory or inventory turns. Again, this is a common measure in manufacturing organizations. It's typically calculated at the company level. And for box score purposes, we want to break it down by value stream level. The reason we want to do this is because value streams may have different characteristics in terms of the products they ship, the flow of the material, the process problems, and the type of material. And so we want to look at each value stream almost like a separate business unit. Quality, again, a standard measure in manufacturing companies. What we want to do with quality is measure first time through the entire value stream. No rework, no defects. That's what we're trying to achieve. We look at this at the value stream level as a whole, because what we want to do from a value stream management viewpoint is understand where the quality problems are occurring, and if we're going to do improvement activities, where can we, put the effort in to get the most return on effort in terms of removing quality problems. Yes, typically quality may be also measured at every cell, and that's primarily used to understand root causes. But from a value, but you look at you look at quality from a value stream perspective as a whole and try to make overall improvement. Cost, a simple, easy measure is average cost per unit. This would be the average or the actual costs of the value stream, which we will explain in a little bit when we talk about plain English financial statements, and units shipped. The idea is that your lean practices, tools, and methods will keep your costs constant, and your units shipped will go up and average cost per unit will be going down. This is more of a performance measure. It's not about what is the cost of a product. And finally, lead time. Average order lead time from order receipt to shipment or delivery. Again, this is like a speed measure. How fast from the time you receive an order can you ship the product? Now, in reality, sometimes customers place orders well in advance of when they want them. I was working at a company a few weeks ago where we were talking about a lead time measure, and one customer said, "Oh, well, we get an order from this one customer 6 months in advance." So in that case, you don't want to measure from the day you receive that order, but you probably want to adjust it in terms of the day you schedule the order for production, for example. So all these measures are very, very important, and the combination of measures, this combination of measures really tells you the progress that lean principles, practices, and tools, the whole deployment is making. Value stream income statement, also called a plain English financial statement. The idea is we're trying to measure value stream profitability. From a financial viewpoint, value streams are the profit centers of a lean organization. We're not talking about business units. We're not talking about products, customers, or markets, or all of that. Now, those, don't get me wrong, those are important analytical tools, but it's really about the flow of the value stream from order receipt to shipment. And that is what is going to drive profitability. We want to use actual direct costs. We want to minimize allocations. And what this means, without me putting the words on the screen, is we're not going to use standard costing information in a value stream income statement. What are the actual costs that the value stream really controls? That's what's really, really important. Because what we want to do is be able to establish relationships between the actual costs and the performance measures and the capacity. Excuse me. We want to minimize and simplify any allocations. We really don't want to allocate costs in only if it's really absolutely necessary to understand value stream profitability. And if we do allocate costs, we want to create a simple, easy method that doesn't require a lot of time tracking or anything like that. A value stream income statement is an internal management report. It's not designed for external reporting. It is designed internally for operational people, finance people, senior leaders, business owners, to really understand what's going on. The focus is on operational accuracy. What was our actual revenue for the period based on the products that were shipped? operational people understand that. They know if the products go out the door or the services are delivered, we've done our job to generate the revenue. From a cost perspective, we're looking at the actual costs for the period being reported. So if we're looking at a monthly value stream income statement, what were the actual direct costs for that period? Now, this is different than the concept of cost of goods sold. And many finance people may not really understand this at the beginning, because I'm a finance person. We're so conditioned that, cost of goods sold is very, very important. But cost of goods sold can be different than the actual costs incurred. And I'm going to show you an example right now. So here's a typical value stream income statement based on standard costing. So we have our revenue, and you can see in period 2, the revenue is greater than in period 1. If you go down to the profit line on the bottom, what you see is profit is about $100,000 less than in period 1. Now, how many of you have experienced this? I'm sure a lot of you have. And this, I remember back when I was a CFO in the 1990s, that I used to really dislike having to do this analysis, because everybody intuitively says, oh, we shipped more, we should make more profit. How could profits be less? Well, here are the problems with this. First, if you look at the gross profit line, you see gross profit is less than in period 2 is less than period 1, excuse me, which people usually say, oh, well, that's a mix problem based on the products that were shipped. Then you go down to the variances. And this is where it gets very, very confusing, because it's the variance analysis is almost like watching a dog chase its tail. And the dog never gets its tail. And variance analysis, the analogy, I use that analogy because in variance analysis, you really never get to the root cause of why the variance occurred. And because the variance could have been created because the standard that was set, or the assumptions that were made in setting the standard, are now not valid. And because it's very hard to set a standard for a long period of time when there's always a lot of variability in manufacturing. And secondly, what happened actually? There's always things which occur which drive costs up, for example. Purchase price variance. Well, our primary supplier could not ship us. We had to go to a secondary supplier to buy some material that we needed for production, and those prices are 10% higher. And of course, you're going to make that decision and you're going to buy it, but that doesn't mean that's a negative thing to do, but yet it shows up unfavorable as a purchase price variance. So it's very, very difficult to explain these income statements. So let's look at the same income statements in plain English format. So our costs are now at actual. We've actually broken down our costs in greater detail than just one line item of cost of goods sold. And these are the actual costs incurred rather than cost of goods sold. Cost of goods sold is based on the units that appear in revenue. It's the idea of matching the cost of the unit to the revenue that is recognized. And that you don't necessarily produce and ship items in one reporting period. But when you look at actual costs, you see that, yes, the total costs in period 2 were greater than period 1. That's expected, but our actual gross profit was higher, which everyone expects. And that is really the job of operations down to that gross profit line. Now, what's the primary reason that net profit was less in period 2 than period 1? Look at the inventory adjustment line. That for external reporting purposes, the inventory adjustment to make the balance sheet equivalent or compliant with reporting purposes was more. And so that drove the net profit down. Now, operations has nothing to do with this. This is a financial accounting exercise. So using a plain English financial statement, it's very easy to see what was the responsibilities of operations, what are the responsibilities for financial reporting, and be able to understand the profitability a lot better. The third piece is capacity. And the idea is that lean activities eliminate waste and create capacity. And we want to be able to measure it because it's a leading indicator of what's going on. And it really explains a lot because most continuous improvement activities create capacity. So we want to be able to measure it on an ongoing basis. And when we get into the case studies, you'll see some real life examples of this. If you look at a box score, if you calculated a current and a future state box score, it's very easy to see, well, we have some improvement activities we're going to do. We're going to improve quality. We expect it to go up from 71% to 78%. Our days of inventory, we expect to go from down to 18.5 from 33. And we're going to see a little bit of an increase in on-time delivery. The future state income statement typically doesn't show a whole lot of change in profitability. The value stream profit of $104,385 only goes up about $3,000, and that $3,000 is a reflection of a decrease in material cost because we're purchasing less inventory. You do see that cash flow has a significant impact. But again, we're not seeing a whole lot of profit change. Why? Because most of these improvements have created capacity. Our available capacity, both in people and machines, has just about doubled through these efforts. And this is one of the important reasons why a box score is needed to be used, especially when it's around looking at improvement activities. So let's look at a box score from a lean strategic viewpoint. The financial benefits of lean are not direct or immediate. Most companies, the expectation is that if we're going to do something, if we have an initiative, if we have a project, we want to understand the financial impact, especially early on, so that we can understand if it's going to help us or not. Lean works differently. And this is something that if people don't really understand lean, it's hard for them to it's hard for them to grasp this. We eliminate waste through improvement. The primary outcome is to create capacity or time. Now, time doesn't show up in financial statements. Capacity doesn't show up in financial statements. In fact, the cost of your capacity, just think of your labor cost, your full-time employees. Well, that's not going to change just because you make some improvements. Now, sure, you may have some reduction in costs because of overtime, or maybe you don't need temporaries. Those costs could be calculated, but typically your full-time people, that's not going to change because from a lean strategic viewpoint, you don't make improvements and then get rid of people. Lean never works that way. So it's the use of the capacity which drives the financial results. You can produce and sell more if there's demand. That will drive revenue growth. Your costs are controlled through all of the lean principles, practices, and tools employed in value streams, which really improve productivity over time, and they will reduce costs over time. You might also get some immediate cost savings. The long run is financial success is dependent on understanding this. Lean is not a short-term financial exercise. Lean is a long-term business strategy which will yield financial success if you deploy lean properly and also use the proper measurements to understand what's happening. The economics of lean is another simple way to explain how lean works financially. We deliver more value to our customers, and on the demand side of the equation, that our revenue growth rate will increase over time. On the supply side, if you think about your resources, all of the different continuous improvement activities and lean practices, what that does is that slows the rate of growth of your costs down. So your revenue increases like 15, 20% a year. Maybe your costs are only increasing 5 to 7% a year. In the long run, you're going to make more money. We also want to have a box score in place to learn new relationships, operating performance, capacity, and financial performance. The relationships between these numbers. Lean thinking, which is really the best way to describe lean, it's about people, employees, and organizations learning. And so the box score can be looked at besides, it's not just a financial tool, it's a learning tool. So that all people in the organization, value stream managers, lean leaders, finance people, senior leaders can learn these new relationships because they're all interdependent on one another. You know, if you make an improvement to operating performance, is there a resulting improvement in financial performance? And you can do that with the box score. You can also look at it the other way. If you want to improve financial performance, what level of operating improvements or capacity performance improvements do we need? The box score also improves the ability to predict outcomes. This being able to measure the capacity that is being created allows you to then decide how are we going to utilize that capacity. We can sell more, we can redeploy resources directly in the business or find other uses for those resources. When you make the decisions about how to use that available capacity, that creates the financial impact. And it is very, very predictable using a box score. Finally, what we're really trying to do through the use of the box score is improve the quality of the decision making throughout the organization. The box score provides relevant information, and this relevant information improves the ability of everyone in the organization to predict outcomes, whether these are operational outcomes, capacity outcomes, or financial outcomes. Secondly, box score information is reliable. It represents reality and it is verifiable. It is real. You can go in there, if you're looking at the productivity measure in a box score, that's what's really going on at the time that the box score is being reported. And this is one of the differences between lean accounting box scores and standard costing information. Standard costing information does not represent reality. And the use of standard costing information in analysis and decisions in a lean organization can be dangerous for a few reasons. Number one is you have a chance to make the wrong decision. And secondly, it also drives mass production thinking. Using the box score throughout the organization also creates standardized work. You have all parts of the organization using the same analytical tool, so you get consistency in the decision making. And what you're really doing with a box score, being able to look at a current state and a future state box score, you're really employing the plan, do, check, act methodology in analysis and decision making. So now let's go in and do a few analysis. First, the standard work. It's pretty simple, and it's really about answering these three questions in any analysis or decision. What's the impact on operations? What's the impact on capacity? What's the financial impact? You have a current state box score, you create a future state box score, and then you make your decision. And you might get a financial impact, you may get a capacity impact, you might get an operational impact, you might get two of the three, you might get all three. It really depends on the decision that you're looking at. But basically, these are the three questions which need to be asked. So in order to do this, I'm going to toggle between the PowerPoint presentation and Lean Think software. Lean Think software is a new product that BMA created, and we released it a few months ago, and it really does box score analysis. So as I do the case studies, you will also see how the software works. So the first analysis, we have a future state goal where a value stream needs to create 20% capacity in 6 months. And this is like part of a strategy deployment plan. So what improvements need to be made? And then, if this capacity is created, what's the financial impact of creating this capacity? So I'm going to exit out of here. I'm going to get into the software. And I want to make sure that the software is showing up on the screen, and it is. So I have everything all set up here. Let's create a new analysis. And I'll call this webinar 1. So what you see at the top here is a current state box score. Here's our performance measurements. Here's our capacity. And you can see that we're at -1 capacity, and we want a future state available capacity to be 20%. And you can see the financial information. I didn't put all this information in advance. So if we go down here to operational, we want to make improvements. We click on the operational box, and what appears is all of the numbers which really are creating the non-productive capacity. Let me review these real fast. We produce in a batch size of 500. We have a changeover time of 60 minutes. We have scrap and rework of 20%. That's a scrap rate, not a first time through rate. Our percentage of items that we have to inspect is 30%. We spend 5 minutes inspecting every item. We have 20% downtime, and we also have 5 minutes per day per person of other non-productive activities. So if you're trying to project what can you do, let's make some broad assumptions. Let's try to make some 50% improvements and see where we get. So if we reduce our changeover time down to 30 minutes, we don't really get much change there. We get, let's go down to 10% in scrap. Let's go down to 15% in how many items we inspect. You can see we're at 8%. Let's go down, let's take downtime down to 10%. We're at 18%. And because we're getting better, maybe we can go down here, 20%. Again, the idea is you can play with this and see the changes. If we reduce our inspection time in half, let's take it down to 2 minutes, we get to our 20%. So now we have an idea of the improvements we have to make over the next 6 months. We can see the improvements in performance right now. We can see the improvements in capacity, and it's all measurable. Now, we don't see any financial improvement here on the right side at the time, and that's one of our objectives. So if we click here and create a future state projection, one of the problems we have, if I open up the production information, is that we're only shipping 4,375 units a month. The demand is 6,500. So let's see, can we meet our monthly demand? So I'm going to put 6,500 in here, 6,500 in here. And if you look at the capacity, we end up with 6% capacity. So yes, we can now meet demand. And you can see how this improves operational performance. Our productivity goes up significantly. We're delivering on time, 100%. Lead time has gone down. Average cost per unit has gone down, and days of inventory has also gone down. So this is all really, really good. And you can see from a financial viewpoint, our return on sales goes from 29% to 37%. We're close to doubling our monthly profit. And you can look at a summary and produce a summary like this. So let me save and exit this analysis. And let me go back to the PowerPoint presentation real fast. Let me make sure you can see the screen. So analysis 2. What we want to do here is our demand is increasing to 7,000 units a month. And this is a permanent increase in demand. So we have to determine how do we create the capacity to meet that demand. And we have a general financial objective of maintaining or improving profitability. So let's go back to the software and let it create a new analysis. So the first thing we'll do is on the production information, we want to enter 7,000 units a month. And what we see is that we need about 24% capacity. Now, this is already good financially, but we don't have the capacity, so we have to make sure that we maintain that improvement in financials. So let's look at the capacity. I'll close this. The first and easiest thing to do is, hey, can we add people? So let's add some people and see what happens here. So 15 people, let me take it up to 18. Okay, that doesn't get us anywhere on the capacity. So we need to, let me double that. Let's make it 21 people. All right, so we're almost back to normal here. You can see 1% capacity. Our profitability is also, we've improved it, so we can hire these people and still make more money. And because we're only at 1% negative capacity, we have this reserve capacity, which is our buffer at 15%. So let me just take that down to 12%. And so we can still do it. And so again, you can view the summary and be able to explain everything that's gone on and the assumptions that were made. Let me go back to the analysis and save and exit. So the third case we're going to look at is another case which typically happens in manufacturing companies these days, is we have 3 long-time employees that are scheduled to retire in the next 12 months. We would like to determine, can we make improvements and not have to replace them? with a financial goal of maintaining or improving profitability. So let's go back to the software. I'm just going to double check that you can see the screen. Let me create the new analysis. All right, so the first thing we have to do is go into capacity, and we have to go down to 12 people. And you can see we have to improve by about 17%. So let me close this. Let me go into the operational piece, and we can again model different scenarios. We can play with the numbers before we save anything. So let's do things like, well, let's reduce the changeover time, and let's also reduce our batch size. Okay, that has a little change up here between productive and non-productive. So let me just take these out. So let's look at scrap and rework. Can we go down to 15%? Okay, that helps us there. How about inspection? Let's go down to 20%. Okay, well, that's getting us close. Let's take downtime. Maybe we can make significant improvements in downtime to 10%. All right, that gets us back to 0. And one of the other goals was maintaining or improving profitability. And as you can see, our profitability gets a little bit better through these improvements. So the answer is yes. Over the next 12 months, if we improve our quality and we don't have to do as much inspection, and we improve if we reduce our downtime, we don't have to replace these people. So let's go back to the presentation. Get it in performance, in presentation mode. So the idea behind these 3 case studies was to just give you an idea of how a box score can work. So let's wrap things up. Our first learning objective. What are the components of the box score? There are 3 components to the box score. Value stream performance measurements, which really measure improvement over time of the performance of a value stream. Value stream profitability, using a value stream income statement, using actual revenue and actual costs for the period being reported. And we use a value stream income statement to develop relationships between value stream performance measures and outcomes, which are the financial statements. So those are the 3 components in a box score. How does a box score improve decision making? It gives us relevant, reliable information for users. It creates standardized work across the whole organization. As I mentioned earlier, box scores are not just used in operations. They can be used by senior leaders. They can be used by sales and marketing. They can be used by finance. And the relevant and reliable information also, and the 3 components of the box score, it recognizes the interdependent relationships between operating performance, capacity, and costs. And the fact that in most analyses, you have to consider all 3 aspects of a box score to get the true impact of any decision. The third learning objective, where can box scores be used? 1, value stream mapping. If your company does current state and future state value stream maps, you should have a current state box score, and you can also calculate a future state box score, which really sets up the goals, the operational goals and the financial goals for a value stream. All types of improvement activities. When we teach and train on lean accounting, one of our suggestions is always every Kaizen event should be accompanied by a future state box score. You talk about improvement activities, which is really, really important. But what is the box score impact? And I like to stress to companies that I work with that using the box score to really explain an improvement activity is a very effective way to get people to understand the impact. Because many improvement activities are highly complex, especially when you're talking about like changing over a machine or change over time on a machine, or maybe even laying out, redesigning a work area and putting in a pull system. And for those who are not familiar with lean, it's very hard for them to understand what are we doing. But if you use a box score and you can show the change in numbers, all people in business understand if a number is getting better or getting worse. It's very easy. And so showing that future state box score, especially early in a report out or in the Kaizen planning process, what are we going to get out of this improvement event? If you show the numbers first, people understand, okay, that's the impact. Then they actually, it opens up their mind about learning what you did. Because I've learned in report outs, watching report outs, that if you just start going into the details of the report out, people get confused because they don't really know what was the outcome. So talk about the outcome first and then talk about the details. All operational planning activities can be run through a box score, creating future state box scores, capital equipment purchases, needing people, what's the impact of demand. All forecasting and budgeting activities can be used. A box score can be used in sales opportunities. This is something that I think is very, very important to incorporate box scores. You want to move away from, well, what's the standard margin on this product if this is the price? You want to look at what's the impact on the box score in total, because a sales opportunity is much, much more than just what's the price and what is a standard margin. It's really about the volume of the opportunity and how does that volume impact the capacity. Because if you have available capacity and you have a sales opportunity and the opportunity in terms of volume is not going to consume all of the available capacity, there is no increase in production costs. So it's a highly profitable opportunity when you look at it in total, even though on a unit basis, using a standard cost, it may not look that good. And finally, in other types of decisions such as make buy. In the long run, you can use box scores in all decisions. Finally, I have something that I like to call the financial learning cycle, which is really part of analysis and decision making. But the focus here is on the way people think. And numbers drive thinking. And every company has a set of data that they currently use for analytical practices, and that drives thinking. And you've used this information for a long time. And so a lot of established thinking patterns have been developed. What you're doing is you're inserting a box score into this. So numbers drive thinking, thinking drives behavior. What behavior do we want to drive? We want to drive lean thinking behavior. The behavior drives decisions. So we want to use a box score to drive decisions that really are focused on the lean strategy. And the decisions drive the numbers. So the idea is to align analysis and decision making with the lean strategy and lean thinking. So what I'd like to do is offer all of you a Lean Think Software webinar special. For attending this webinar, whether you attended it live or if you watch the recording, what we're going to do is offer a 3-month discount on an individual subscription. The regular price is $89. We're going to offer it 3 months for $49, And this includes a 15-day free trial, so you actually get it for 3.5 months. If you're interested in this opportunity, send me an email and I'll get you, send you information to get you registered. You have a month to do this registration. So if you're watching the recorded webinar, you have till January 12th to take advantage of this offer. Just send me an email, tell me you attended the webinar, and then we'll get you set up. You can also visit the website, www.leanthinksoftware.com, to learn more about the software. If you'd like access to all our recorded webinars, this is the link. There's probably about 15 webinars on there over the past couple years. These webinars were free and they remain free. And you can share this link with other people in your organization or outside of your organization, and they can watch the webinars as often as they like. And finally, there's other learning opportunities. Our website, blogs, and articles. Please contact me with any questions that you may have regarding this webinar, recording lean accounting in general. I love to talk about lean accounting. And we have the BMA LinkedIn accounting group. So that wraps up the webinar. And I'm glad you could attend, and stay on our mailing list and we'll let you know about future webinars. Bye-bye.